Hi, my name is Jolene Kendrew and I am an accounting instructor at Camosun College. This video is work product of the college. In this video, we will be reviewing a comprehensive question on consolidation. The question we will be reviewing is a complex example, and while we will briefly discuss some of the theory behind the various components as we go, I recommend prior to viewing this particular video that you have already attended several classes on accounting for consolidation, post-acquisition date, including coverage of intercompany transactions and deferred income taxes. If you are a current Accounting 310 student, you should have worked through the Accounting 310 workbook up to example 22. As you would have discussed it in your Accounting 310 class, consolidation questions can be intimidating as they may be several pages long and include a large amount of information. Therefore, it is important that we have a process for working through these questions. In your workbook, you would have been introduced to the 5 steps of consolidation, which we will briefly review here. The first step is to identify what is required. Are you being asked for consolidated financial statements, specific consolidated balance, worksheet entries, or a combination of these 3 items? It is important that we identify this right away so we do not waste time preparing information that's not required in our response. At the same time, there are several factors we need to watch for that will affect our response. Are capital assets reported net or gross? Remember that if they are reported gross, we will need to eliminate the accumulated amortization or depreciation on the books of the sub at the date of acquisition. This will also impact how we account for any adjustments to amortization in our elimination entries later on. Is there goodwill on the books of the sub? If there is, we learned that goodwill on the books of the sub is not a separately identifiable asset in our fair value assessments at the date of acquisition, and therefore is assigned a fair value of 0 and eliminated on consolidation. We need to identify if this is relevant for this question or not. And finally, we need to determine which method of valuation is required for NICSHI. Remember, under the acquisition method of consolidation, which is the required method of consolidation for both ASPE and IFRS, there are 2 options to account for NICSHI. The fair value, or full fair value method, and the net identifiable assets method. The difference between the 2 is whether or not we assign NICSHI a fair value for their imputed portion of goodwill upon acquisition. We do so under the full fair value method, but not under the net identifiable assets method. Next, we will determine the date of acquisition and reporting date. If the reporting date is post-acquisition, it is critical that we correctly calculate how many years have passed since acquisition, as an incorrect calculation will result in many errors in our later response. While it seems simple, taking the time to slow down and calculate the number of years carefully will save you from discovering such an error later in your response. Thirdly, how has the investment been recorded on the investor or parent's books? Remember that consolidation is what's required for reporting on parents' financial statements, but on their books they can choose to use either cost or equity method. Cost is the simplest scenario, since the investment asset value would remain unchanged over time, and we can simply eliminate it during our consolidation via the investment elimination entry. However, if parent has chosen to use the equity method on their books, the value of the investment would have changed on their books when the sub earned income and declared dividends, just as we saw in our exercises on the equity method earlier in the course or in the workbook. Before we could record our consolidation elimination entries, we would first need to record elimination entries to reverse the impact of the equity method entries. This certainly complicates things, but is necessary to end up at the correct consolidated figures regardless of what parent recorded on their books. Our 4th step of consolidation is to prepare a goodwill schedule or a purchase price discrepancy schedule. Regardless of what our required is, we will almost always need to prepare this schedule. This is because it outlines for us why parent paid what they paid, and separates the purchase price between our 3 main components: the book value of the sub, the fair value increments or decrements on the purchase of the sub by parent, and ultimately helps us calculate the goodwill generated on the purchase of the sub. We will return to this shortly. Finally, if elimination entries are required, as determined in our 1st step, step 5 gives us an order to prepare them. By using this order, our response is logically laid out and easier for anyone reviewing our work to follow. It is always beneficial to provide clear and logical work, especially if it ends up containing errors, so that even if our numbers are wrong, the reader can clearly see that we understand what we were doing. If you are watching this video and you are a current student in Accounting 310, we will be working through example 22 provided in your workbook. If you are not a current student, you can pause the video at various points and get the information to solve the question as we go. The best way to use this video is to pause at each stage of the calculations and see if you can do them without assistance. Then you can immediately verify your work to the video. Here's the question that we will work through. Before discussing the question, I will briefly display each page of the question on the screen. This will allow those of you without the question to pause the video and record the question information before we begin reviewing it. We will then read through the question together. Okay, we are now going to critically read through the question, identifying important case facts as we go. The ability to pull important information out in a logical manner is critical to being able to piece together all the facts as we prepare our response. So let's get started. On December 31st, 2011, the Pastel Company purchased 90% of the outstanding voting shares of the Shade Company for $5,175,000 in cash. So just from this first sentence, we already know that Pastel is parent, Shade is sub, and Pastel has purchased 90% of Shade. So they control the sub. On that date, the Shade Company had no par common stock of $2 million and retained earnings of $4 million. So this tells us the total book value of Shade's equity, assuming we aren't given additional information later saying there are additional equity balances. So the $2 million plus the $4 million, we know the book value of the equity is going to be $6 million. All of the Shade Company's identifiable assets and liabilities had carrying values equal to their fair values except for accounts receivable with fair values $50,000 less than their carrying values. So that is a fair value decrement. Land, which had a fair value $100,000 greater than its carrying value. That will give us a fair value increment. Equipment with a fair value $1 million less than their carrying value and a remaining useful life of 10 years. So another fair value decrement. And long-term liabilities, which had fair values $400,000 less than their carrying values and mature on December 31st, 2021. So because this is a liability, even though the fair value is less than the book value, that gives us a fair value increment. Also important to point out, we've been told a useful life for equipment. We've been told a maturity date for long-term liabilities, both of which will help us determine the amount of fair value amortization we're going to take each year. So all four of these bullets are here to help us with our fair value increment and decrement calculations. You may find it useful in such a large question to use margin notes, whether you use the right or left margin, so that you have a reference point to come back to when you're looking for information. Before we analyze the rest of the information, I'm going to jump to the end of the question to see the required, just so we have it in the back of our mind as we're reading through the question. So if we flip forward, we have two main requireds. The first is to prepare all elimination entries necessary for consolidation at December 31st, 2016. Okay, so that gives us our end date and also the following balances at December 31st, 2016. Quite a few of them. Important to note, two of the main ones we're going to have to be calculating are net income and retained earnings, and we'll look at some strategies for calculating those later on. Okay, we've got our date, 2016. That is 5 years after acquisition. The acquisition date was December 31st, 2011 at the beginning of our question. It's very, very important we get the number of years correct, so it's worth noting at the top of your response page at this point. I will just note it at the top of our question. We are 5 years later. Okay, on to the balance sheet. So let's take a moment and see what key information we can pull out from this balance sheet at this point. If you'd like, you can pause the video and take a moment and see what you can identify on your own. There are several things that I identify right away. First, the date of the balance sheet, December 31st, 2016. 5 years after the acquisition date, and matches are required. Right? We would expect this given our requirement to report at that particular date. Next, there's no indication of any goodwill on the books of the sub. This means we don't need to worry about eliminating it. Next, both the building and the equipment are recorded net of accumulated amortization or depreciation. So we're not going to have to eliminate the sub's accumulated amortization upon acquisition. We will also need to watch out in our other elimination entries that we do not make adjustments to the account accumulated amortization, as this account does not exist for reporting purposes on parent's consolidated financial statements. Just below that is the investment in shade. We can see that the balance of the investment has not changed over the 5 years. It's still the original purchase price for the 90% the parent bought. This tells us the investment is recorded on parent's books at cost. We are also told this in the description of the account, but we could have determined it based on the fact that the balance is unchanged if we weren't told explicitly. Next, there is a dividend payable on the books of sub. If sub had declared dividends, which it looks like they have, most of these will be going to parent, since parent owns 90% of the sub, so we'll have to consider this when we're looking at intercompany transactions between parent and sub. And we'll need a little bit more information to know when those dividends were actually declared, to know whether it's a current year transaction we have to deal with or not. The only other thing that I would note at this point on the balance sheet is that sub's common stock has remained unchanged from the acquisition date. This tells us no new shares have been issued and no shares have been retired. And since we haven't been told otherwise, we know that the ownership structure of the company has not changed since acquisition. This is our simplest case scenario, so it keeps things easier for us as we analyze parents' consolidated financial statements. On to our income statement. So same thing here, let's identify anything that we think may be important to us as we go through our consolidation. So our income statement is the same date as our balance sheet, as we'd expect, still 5 years post-acquisition date. First, it's a good idea to take note of the types of accounts and the names of the accounts on the income statement. As when we make adjustments to these accounts, we want to make sure we're making adjustments to the right accounts and not accounts that don't exist for reporting purposes. For example, there is no account called interest expense. So if we have adjustments that would typically go to an interest expense account, we need to determine where parent and sub have recorded their interest expense to, so that we're adjusting to the correct place. We don't want to adjust to an account that doesn't exist on the financial statements if we're adjusting an existing balance. We'll likely see further additional information in the question that will help us to determine this and give us more information on where things have been recorded. The only other thing that I would note here is that Pastel has had a gain on the sale of land and building. If this relates to a transaction between parent and sub, we'll use this information in our analysis of the intercompany transaction. On to the other information which makes up a critical part of the question for us. Number 1. In each of the years since Pastel acquired control over Shade, the goodwill arising on this business combination transaction has been tested for impairment. After completing the annual impairment test, it was determined that the impairment of the related goodwill was $15,000 for 2016. No impairment was found in any of the other years since acquisition. So there was no impairment from 2012, or the end of 2011 at acquisition, until 2016, and we're told a dollar amount of impairment in 2016. This is a little more unusual, as we're often told a percentage of goodwill. We're actually told a specific dollar amount of the goodwill was impaired. We will need to consider this goodwill impairment in our fair value increment amortization. Number 2, both companies use a straight line method to calculate all amortization charges. Good, this keeps any adjustments we have to make to amortization simpler. Number 3, Pastel uses the cost method to carry its investment in Shade. We already knew this from our analysis of the balance sheet, but it's nice to have confirmation. Number 4, the sales account in the Pastel company's income statement includes only sales of merchandise. All other income is accounted for in other revenue or a separate gain account. This gives us a breakdown of how each of the revenue accounts has been used. which will be helpful in determining the appropriate accounts to adjust to if we have any elimination entries that affect revenue accounts. Number 5. During 2016, Pastel charged Shade $100,000 for management fees. None of this amount has been paid during 2016. The salary paid to the manager who performed the work for Shade totaled $75,000 for 2016. We're starting to get into intercompany transactions now. As we identify each of them, it's helpful to give them a number so that we have a logical checklist when we work through them and complete each of our elimination entries. There are also many intercompany transactions in this question, in fact more than you would typically see in an exam, but good practice. So it's important that we have methodology to keep them all straight. So the first transaction identified here is an intercompany management fee and related AR/AP. Let's call this transaction 4B, interco management fee. I've done this as transaction 4B because intercompany transactions are the fourth step in our elimination entries using the 5 steps of consolidation, and B because we usually deal with intercompany dividends first as 4A so that we don't forget about them. And we've already identified from the balance sheet that we have sub-dividends in this question. So we'll leave 4A for dividends and give our management fees 4B. Number 6, here are our dividends. During 2016, dividends of $200,000 were declared and paid by Pastel, and dividends of $100,000 were declared by Shade. On December 31st, 2016, the dividends that were declared by Shade Company during 2016 had not yet been paid. So this provides a bit of clarity from that dividend payable we saw on the balance sheet. So here are our intercompany dividends for A, interco dividends, as well as confirmation that they are current year dividends that have been declared by sub and they have not been paid out, which is why we have a dividend payable. Remember, we are not concerned about parents' dividends declared. Those go to parents' shareholders, have nothing to do with sub, and are not an intercompany transaction, so there's no need for us to worry about eliminating them. It is only the intercompany dividends declared by sub and paid to parent and NICSHI that we need to deal with. Number 7. During 2016, Shade sold to Pastel $500,000 worth of merchandise, of which 75% had been resold by Pastel in 2016. Pastel owes Shade $75,000 on December 31st, 2016 due to these purchases. We'll just stop there as that identifies an intercompany transaction for us. This is an upstream intercompany inventory sale that originated in 2016. So let's identify it as 4C. We'll call it upstream, or an up arrow. We'll identify that in my margin notes. So we'll call it an upstream 2016 inventory sale. Okay, giving us enough information to be able to come back and pull out the necessary facts later. Let's continue on. The December 31st, 2015 inventories of Pastel contained $300,000 of merchandise purchased from Shade in 2015. So that sentence gives us another intercompany inventory transaction, this time one that began in 2015. So we will call this 4D. It's still upstream from sub to parent, but it is a 2015 inventory transaction. Finally, the Shade Company's sales are priced to provide it with a 60% gross margin on its sales price. The gross margin information here will help us determine the profit from these sales, both of these intercompany inventory upstream transactions, that needs to be eliminated for both 4C and 4D. Number 8. During 2015, Pastel sold $300,000 of merchandise to the Shade Company and earned a total gross profit of $120,000 on these sales. On December 31st, 2015, $150,000 of this merchandise is still in the inventories of Shade. So we'll stop there. We'll call this transaction 4E. This is now a downstream from parent to sub, 2015. The transaction originated in 2015 and still an intercompany inventory sale. During 2016, Pastel sold merchandise which had cost it $60,000 to Shade for $150,000, and none of this merchandise was resold in 2016, and Shade had not paid for these purchases at the end of 2016. So one more inventory transaction, still still downstream, but this one began in 2016. It's a current year intercompany inventory transaction. Remember, with inventory, we're very interested in knowing what year the actual intercompany sale between parent and sub happened. Was it last year, the current year, or another particular year? And we may refer to these as year 1, year 2. In this case, for example, for F, the 2016 inventory transaction happened in the current year, so we are in year 1 of the inventory transaction. Remember also that inventory is a 2-year transaction. If it's not sold to a third party in year 1, it will be sold to a third party in year 2, and so we only have to deal with 2 years of an inventory transaction. We'll revisit that when we get to actually doing the elimination entries for these transactions. Number 9. On January 1st, 2013, Shade sold a piece of equipment that it had purchased on January 1st, 2010 for $180,000 to Pastel for $120,000. On January 1st, 2010, the equipment had an estimated useful life of 18 years with no net salvage value, and there is no change in these estimates at the time of the sale to Pastel. We'll call this 4G, another intercompany transaction, upstream from sub to parent, and this is a sale of equipment. So no longer inventory, we're dealing with an intercompany sale of a capital asset. Number 10. On December 30th, 2016, so that's 1 day before the date we're reporting on, Pastel sold to Shea for cash of $1.5 million, a building with a net book value of $800,000, and the land it was situated on, which had an original cost of $200,000. Shade allocated $1.1 million of the purchase price to the building, and the remainder to the land. The building has an estimated remaining useful life of 25 years on this date. The gain on the sale is disclosed separately for reporting purposes on Pastel's books. Here's our explanation of that gain on the 2016 income statement. We are dealing with a 2016 intercompany transaction. It is downstream from parent to sub, and it's a sale of land and building. Okay, number 11. At acquisition, let's back up 1 second. We didn't give this a number, so we'll call that 4H. It's our final intercompany transaction we've identified. Number 11. At acquisition, the management of Pastel measured the non-controlling interest in Shade based on the fair value of the identifiable net assets of that company. It is very important we don't miss this piece, even though it's at the end of a lot of information. This is one of our 5 steps of consolidation. How is parent accounting for NICSHI? And we now know that they are using the net identifiable assets method. So we won't be recording an amount for NICSHI related to goodwill, and any goodwill impairment should not impact NICSHI's share of sub's income or retained earnings. Number 12. Shade has sold no land since 2010. While it may not be obvious at first, this is to help us with the fair market value increment on sub's land at acquisition. We don't need to amortize it since it has not been sold, and we only amortize fair value increments of non-depreciable assets when they're sold or impaired, neither of which has been identified to have happened here. Finally, number 13, Shade's tax rate is 30%, Pastel's is 40%. We will need these tax rates to determine our DIT impacts of the various elimination entries that we need to record. And we're back to our required. Prepare all the elimination entries, and once we've done so, we will come back to our direct balances. The elimination entries will help us with the direct balance calculations, as we'll have all the necessary adjustments from the entries to the balances already laid out for us, and we will revisit them once we've done our elimination entries. Now would be a good time to pause the video, to reread the question once more on your own, to ensure you've gathered all the necessary facts and made all of the margin notes that are useful to you. You can then complete the required calculations on your own. When you have completed your calculations, return to the video to review your work. Our first required is the elimination entries. However, we know from our 5 steps of consolidation that before we can do these, we need to prepare our purchase price discrepancy schedule, or goodwill schedule, to allocate the purchase price among the various components. Please pause the video and attempt this schedule now, and then return to the video to review your work. When you complete your goodwill schedule, it's a good idea to follow the same format each time. This schedule, when used and completed correctly, gives you a roadmap for your fair market value increments, as you'll see here. So we start with the purchase price of $5,175,000. However, that was for only 90% of the sub, so we need to impute what the price would have been if they had bought 100%. This is calculated to be $5,750,000. To get there, we take the $5,175,000 and we divide by the portion they own, which is the 0.9. When we subtract the $6 million book value, which was the 2 million common shares plus the 4 million retained earnings, we end up with a negative $250,000. So the book value of sub exceeds the imputed purchase price. We'll see why as we go through the rest of our schedule. So next step, we identify each of our fair value increments as laid out for us in the question. First, accounts receivable. We record our decrement of $50,000 that was identified. The receivables are not something that we see very often. In this case, it's a result of, at acquisition, the parent has determined that some AR, or as this case we're calling current receivables, on the sub's books are bad debts. So parent is writing them off as part of the purchase price discrepancy. We have a land increment of $100,000, equipment decrement of $1 million, and a bonds payable increment of $400,000. Then we can't forget the deferred income tax, or the DIT, on the net fair value increments, using the parent's tax rate of 40%. So the $550 times 40% gives us the $220,000 DIT asset. We have to record this because parent has tax implications on acquiring the assets at a different value from their book value, which we assume to be the tax carrying value. At the end of our calculations, this results in goodwill of $80,000. And ultimately we want to do the math and make sure that we've got to our negative $250,000 again, because these figures need to agree. It's a good double check for us that we've calculated our goodwill correctly. To the right of our goodwill schedule, we need to calculate what the fair value increments, when they'll be amortized, and how they will impact net income in the current year in 2016 and retained earnings by the end of 2016. Right, so 2 additional columns. This is our current year income statement impact, and this is the impact on retained earnings by the end of 2016. So we'll start with accounts receivable. Accounts receivable is a current asset unless we're told otherwise. So we know that we need to amortize the entire amount in the first year. By amortizing the current receivables in the first year, we're saying that in 2012, the first year after acquisition, either the sub collected this AR, so we can now reverse the bad debt calculated at acquisition, or the sub wrote it off. And if they wrote it off, parent already did that at acquisition, so we're reversing the impact of sub's entry, so the write-off is not double counted. So no impact on current year net income, but by the end of 2016, the end of the 5 years, the entire $50,000 is amortized. For land, we have no fair value increment amortization to deal with, because it is a non-depreciable capital asset, which we would only amortize and have to adjust for this fair value increment in this case if the land had been sold or impaired. And we were told near the end of that other information that the land was not sold and there's no indication of impairment. For the equipment, we have this additional $1 million of fair value lower than book value, and we're told the useful life of the equipment is 10 years. So sub will be amortizing the rest of the equipment at its book value on sub's books over the next 10 years. But parent says that each year that amortization calculation by sub is off by $100,000, which is our $1 million divided by the 10 years. So parent wants to adjust the amortization by $100,000 each year. By the end of the 5th year, we have a total adjustment of $500,000. We've amortized $500,000 of that fair value decrement. For our bond payable, we were told the maturity date, which was 10 years from the date of acquisition, so that gives us our period to amortize this fair value increment over. So we'll be amortizing $40,000 a year. By the end of the 5th year, we have a total fair value increment amortization of $200,000. This arises because we have a fair value that is significantly lower than what sub has on its books. So the fair value has dropped over time. We know that our inverse relationship with bonds, the fair value drops. That tells us the interest rates must be higher. So parent expects to have a higher interest expense based on when they bought sub and they bought these bonds payable as part of sub, which they now control. And so parent says my interest expense should be higher on the consolidated financial statements. So that's what we're adjusting here, is our interest expense each year by $40,000. Our DIT asset, we can do the same calculation for the current year net income and the cumulative retained earnings, which is 40%, parent's tax rate. And then finally, For our goodwill, we were told there was exactly $15,000 in impairment in the current year, which would give us a total impairment of $50,000 by the end of 2016. Now, one final thing on our schedule before we get into our entries. Important thing to note is that this goodwill calculation is based on 100% of the imputed price of parent. And we know that parent uses the net identifiable assets method for the calculation of NICSHI. So parent's portion of this $80,000 is only going to be 90% of the 80. The other 10% will not be recorded. So the goodwill we actually record in our investment elimination entry will be a lower figure than the 80,000 we've calculated here. Okay, now let's begin our investment elimination entry, which is our first of the elimination entries we need to record. So we'll call this entry number 1, and we'll see later in our direct balances it's important to number each of our entries so we can refer to them later. So a few things we're looking for when we complete our investment elimination entry. First, we want to make sure that we eliminate the common stock and retained earnings of sub at the date of acquisition. We want to record each of our fair value increments and decrements. So we have land, long-term debt, current receivables, and equipment, as well as the related debt asset. And all of those figures are coming straight from our goodwill schedule that we just completed. We want to eliminate the investment in sub on parent's books, which we know is recorded at $5,175,000. Remember that that's just parent's 90%, the amount that they actually paid. The other party involved is NICSHI, which we'll calculate in a moment. But first, let's go to our goodwill. We saw on our goodwill schedule that the calculation of goodwill was actually $80,000, but we know that parent only gets 90% of that attributed to them. And because we're using the net identifiable assets method for NICSHI, we're only going to record parent's portion of the goodwill. If we were using the full fair value method, we would record the entire $80,000. Our final figure to include is NICSHI. Now certainly we could get to NICSHI by plugging this figure, if we assume all of our other calculations are correct, but it's good to calculate it as well to make sure we get to the same number. So NICSHI is going to be 10% of the net identifiable assets of sub. So to get to the net identifiable assets, let's start with the book value of sub, which was $6 million at acquisition. Pardon me, I should be saying the fair value of the net identifiable assets. So starting with book value, to get to fair value, we can take our net fair value increments, net of the DIT, which we calculated in our goodwill schedule to be $330,000, lower than book value. So that brings us out to $5,670,000 to give us the fair value of the net identifiable assets of the sub, and 10% of that goes to NICSHI. So $567,000 is our valuation of NICSHI for parent on parent's consolidated financial statements at the date of acquisition. Our next step in our elimination entries is to deal with the fair value increment amortization. Now, since we've done all of our calculations already to the right of our goodwill schedule, this should be relatively straightforward. So first we'll deal with those current receivables. We knew that there was a fair value decrement of $50,000 at acquisition. We're now amortizing that, and a good rule of thumb to check is if we look back at our investment elimination entry, we credited the current receivable. So in order to amortize it, bring it back to book value, we need to debit the current receivables. The other side may have gone through a bad debt expense account in 2012 when we actually had a current year adjustment to this, but because it's a previous year, we need to adjust through retained earnings. So what would the impact on opening retained earnings in the current year 2016 be? Remember that our elimination entries are not actually posted anywhere. They're recorded only for the purpose of consolidation, and so because of that, every year we have to re-record them, how they would impact the current year financial statements. And if they impacted a previous year income statement, we have to adjust through retained earnings to show that it would have adjusted ending retained earnings in a previous year and current year opening retained earnings. Second, we'll call it 2B, we have our equipment. So we had a fair value decrement where we dropped equipment down by $1 million. We're slowly bringing ourselves back up to book value, so the $500,000 debit. $100,000 of that is in the current year. That's an adjustment to our amortization expense to bring it down based on the lower fair value that parent assessed at the date of acquisition. And the amortization expense is the account that we have listed on our income statement that the actual amortization expense would have gone to, so it's appropriate for us to use here. The other 4 years of adjustments will be adjusted through retained earnings. Next, we have our long-term debt. We'd mentioned that because the fair value had gone down, we know that interest rates were higher at the time that parent acquired sub, so parent thinks that interest expense should be higher from their perspective. There is no interest expense account on our income statement, so we're going to adjust through other expense, as that must be where parent and sub have recorded their interest expense, so it's an appropriate place to adjust that amount. The previous years flow through retained earnings, and the total adjustment is $200,000 to long-term debt. Long-term debt is often one that we reverse our entry on, so let's do our double check, jump back to our investment elimination entry, and we can see we debited long-term debt on our investment elimination entry to come down to our fair value. And now we're crediting long-term debt in order to amortize our fair value increment. So always the opposite effect in step 2, our increment amortization. Next up is our DIT. This one can be tricky to understand, but if we look back at our goodwill schedule, we can see the $18,000 was calculated as the current year amount, the $105 was calculated as the total adjustment to the DIT asset, and the difference flows to retained earnings to represent the cumulative effect of the prior year fair value increment amortization. Finally, we have our goodwill impairment. We were told it was a $15,000 impairment in the current year, so our goodwill needs to drop by $15,000, and we will debit either goodwill impairment loss or other expenses. Now goodwill, because the impairment loss is a product of consolidation in that the goodwill did not exist on the books of parent or sub, it's only an account set up for consolidation, it would be appropriate to adjust to an account that is not showing on the financial statements currently. Because we're not adjusting an existing expense, we're recording an additional expense. However, if you recorded to other expenses, that would be appropriate here. Okay. Once you've completed your fair market value increment amortization elimination entries, it's a good idea to go back to the right-hand columns of your goodwill schedule and just make sure that the entries are having the impact that you were expecting based on your calculations in that schedule. So if we jump back to our goodwill schedule, we can see we were expecting a net impact on income for the year of $27,000 less expense. So that would be an increase to net income. And by the end of 2016, the impact on our ending retained earnings should be $230,000 less expense. Remember the way that we've set up our numbers in these columns, a positive number is like an expense, so it's a negative impact on net income. Because we ended up with negative numbers, it's a positive impact on net income or retained earnings, so less expense. So $27,230. Let's just mark those to remind ourselves. So that was ending, retained earnings, and net income in the current year. So first let's look at anything that has impacted the current year net income. So I'm looking for income statement accounts. You can see amortization expense. We have other expense. We have a deferred income tax expense for the current year, and we have a goodwill impairment loss for the current year. If we add those 4 amounts up, we should get to an income statement impact of negative $27,000, so a net credit of $27,000, and we do. Now in order to see our impact on ending retained earnings, we have to remember that anything that impacts the current year income statement will also impact ending retained earnings in the current year. So all of our income statement accounts that we've already circled will also impact ending retained earnings. In addition to that, the amounts we have debited or credited to retained earnings, implying opening retained earnings, will also impact ending retained earnings. So let's circle those as well and add them to our calculation. So if we add together all of the amounts that are now circled, so including the income statement amounts, we will get to an impact on ending 2016 retained earnings, and that will come out to the $230,000 net credit that we were expecting, so net increase on retained earnings. If you do your double check here and you don't get the numbers that you had on the right-hand columns of the goodwill schedule, a couple things could be happening. The first and most common thing that could be happening is that you've reversed one or more of these entries. So you've debited when you should have credited, or vice versa. A couple things to check. Check the impact and see if it was what you were expecting for that specific amount compared to your goodwill schedule. Also check and see if you are adjusting the account the opposite direction from what you adjusted in the investment elimination entry. For example, in the investment elimination entry, we credited current receivables. We're now debiting it to amortize the fair market value increment. We'd expect them to go opposite directions. The other thing that may have happened is in your goodwill schedule, you may have an error in the calculations of the impacts in your right-hand columns as to what the impact on the current year income statement and ending retained earnings are, but you've done them correct in your entries. So it's worth going back and checking whether or not you've been consistent between the two, account by account, and if not, where did you make the entry? Was it in the goodwill schedule columns or was it in your elimination entries? Okay, our third step in our elimination entries is to allocate a portion of retained earnings to NICSHI since the date of acquisition. Our initial valuation, when we calculated NICSHI in the investment elimination entry, was based on the balances at the date of acquisition. Since that time, subs' retained earnings have changed. They've earned income, in some cases a loss. In our case, it's income, cumulative over the last 5 years. And so for parents investors, they need to understand that a portion of that is attributable to NICSHI and not to parent. So we take our retained earnings of the sub at the current date, the $6 million in 2016, take away the $4 million at the date of acquisition, which tells us there's been an increase of $2 million since parent acquired sub. We know that NICSHI needs to have a portion of that. However, NICSHI also has to share in the fair market value increment amortization since we recorded 100% of the fair market value increment amortization. The exception to that is any goodwill impairment. Since their valuation does not include goodwill, it shouldn't include any goodwill impairment. So that $245,000, if we jump back to our goodwill schedule, was the amount above the goodwill impairment, and because it's a negative number, it's actually telling us there will be a total of $245,000 less expense, which means ultimately an increase to retained earnings. And if we review our fair value increment amortization entries, we should get that exact $245,000 as our net adjustment to ending retained earnings. Remember, if you're calculating ending retained earnings, you have to include any adjustments to current year income statement expense in that calculation. So the $245,000, which is actually going to increase our retained earnings based on our fair value increment amortization, brings us to $2,245,000. And NICSHI's portion of that is 10%. So we need to increase NICSHI by $224,500 for the last 5 years of subs change in retained earnings due to their earnings. So our entry will be to take that $224,500 out of retained earnings and allocate it to NICSHI. All right, our fourth step of dealing with our elimination entries is looking at any intercompany transactions. Remember, the purpose of these elimination entries is to make sure that any transactions between parent and sub do not exist for the purpose of the consolidated financial statements. So any journal entries that have been recorded on parents' books and subs' books related to these, we need to do some elimination entries to eliminate the effect of those transactions so that they don't show in the consolidated financial statements because they don't exist from a consolidated perspective. They're transactions that parent is performing with themselves. So we need to get rid of them. So we're going to work through them in the order that we identified them in our walkthrough of the question, starting with 4A, which is our intercompany dividends. So the question information we were given was other information number 6. During 2016, dividends of $200,000 were declared and paid by Pastel, and dividends of $100,000 were declared by Shade. On December 31st, 2016, the dividends that were declared by Shade Company during 2016 had not yet been paid. If you remember as well, back to our balance sheet, there was a dividend payable of $100,000 on Shade's balance sheet, which would relate to this because they're telling us these are unpaid. So first of all, we do not need to worry about those dividends that Pastel declared. Those dividends would have gone to Pastel's shareholders, nothing to do with an intercompany transaction between parent and sub. These $100,000 in dividends is what we are concerned about, current year dividends declared by Shade. Now remember, when Shade declared those dividends, only 90% went to parent, so $90,000. The other 10% went to NICSHI. Now NICSHI is a third party, and so that part of the transaction we don't need to worry about eliminating. It's the portion with parent that we are concerned, because its dividends have essentially been declared to ourselves and are payable to ourselves. We need to eliminate the effect for our consolidated statements. So we've got two entries we need to do. The first is going to be to eliminate that revenue. Now we have to look at our income statement and figure out which account the dividend revenue would have been recorded in. Remember, parent recorded subs investment at cost, so when they receive these dividends, they would have recorded, when the dividends are receivable, they would have recorded a receivable and some dividend revenue. If you look back to our income statement, we did not have an account called dividend revenue, so we don't want to try and take the revenue out of an account that doesn't exist. From the information we were given, other revenue is where those dividends would be sitting. So we're going to debit other revenue to reverse the impact of that credit that parent would have recorded, and put the revenue back into retained earnings where sub would have pulled it out of to declare the dividends. Now we can't forget, because they were not paid, we have a payable and a receivable on our books. The payable of $100,000 includes that NICSHI portion, so only the 90 portion is what we need to eliminate for our consolidated statements. So we'll clear out the dividend payable, set up clear out the current receivable that parent would have on their books. Our second intercompany transaction is the intercompany management fees. Now, if this is a type of transaction you haven't seen before, one of the most beneficial things to do is to sit down and go, well, what would parent have on their books related to this? What would sub have on their books related to this? And then what cannot be there for consolidated statements? So what do we need to eliminate? So as a reminder, the information we were given was number 5 under other information. During 2016, Pastel charged Shade $100,000 for management fees. None of this amount has been paid during 2016, and the salary paid to the manager who performed the work for Shade totaled $75,000 for 2016. So first, looking at that $100,000 in management fees, we quickly remember what would have been done on parent's books and what would have happened on sub's books. Well, parent charged sub, so parent would have some revenue related to this, which is sitting in other revenue, and they would have some sort of a receivable. Sub, however, would have had a management fee expense, probably sitting in other expenses. That's the most logical spot for it. And they would have a payable, current payable according to our balance sheet. Okay. So two problems here. The first is that we have a receivable and a payable to ourselves, which we need to get rid of. We also have some revenue and expense to ourselves. Now the net effect on consolidated net income is 0, but with these entries recorded and us not doing anything about them, our revenue is $100,000 too high and our expenses are too high. So both are overstated. So our first entry will be to eliminate that revenue and expense, and our second entry will be to eliminate the current liabilities and current receivables. Now often we get stuck on this salary. So the salary paid to the manager who performed the work was $75,000. That salary really has nothing to do with an intercompany transaction between parent and sub. That was an actual cost incurred by Shade, paid to a third party, the manager. And so that really is just extra information we're provided with that does not relate to our elimination entries at all. Next, we're going to look at 4 different inventory transactions that we identified during our walkthrough of the question. Before we jump into the specific transactions, let's remind ourselves of the 4 steps that we need to look at and go through as we're figuring out the elimination entries for these intercompany inventory transactions. So the first thing we need to do is to eliminate any intercompany sale that occurred during the current year. Now you would have learned in your classes if it was last year, we don't need to worry about the intercompany sale because the net effect on opening retained earnings would have been 0. So if you do your entry, you'd see a debit to retained earnings, credit to retained earnings. Okay, but if we're in year 1 or the current year of an inventory sale, that is relevant. Okay. Then we come to probably our trickiest step is eliminating the unrealized profit or loss. So if there is inventory still on hand at the end of the current year that parent sold to sub or sub sold to parent, that inventory a component of the cost of that inventory contains or is profit or loss. It could be either one. We need to figure out the value of that unrealized profit and loss so that we can eliminate it from the consolidated statements, because we can't recognize the profit or loss until it goes to a third party. On the same lines of that unrealized profit or loss, even though we're not recognizing it for consolidation, for tax purposes, we're going to be taxed on that profit or loss in the current year. So we need to record the DIT related to that, okay? And our DIT will always be at the seller's rate, right? So if parent is selling to sub, it's parent's unrealized profit or loss that we're eliminating, and we'll use parent's tax rate. And then finally, if we're dealing with an upstream transaction, NICSHI has to share in this adjustment that we're making to profit or loss net of the DIT. And so we'll make an adjustment to our NICSHI balance based on the amounts we calculate in steps 2 and 3. So the first intercompany transaction we identified, we called it 4C in our walkthrough, and it is a 2016 upstream sale of inventory. Now I didn't mention this for 4A or 4B, because those entries, those transactions tend to be quite obvious as far as the entries that we're doing, but when we're dealing with 4 different intercompany inventory transactions, it's really, really important that we identify which one we're dealing with and we properly name things so that if someone is looking at our work, they can figure out which transaction we're actually dealing with, particularly if our numbers are incorrect. In fact, it's a good idea throughout all of our entries to make sure we're using headings, titles, descriptions of what we're doing so that our work can be followed. So the question information related to this inventory sale. During 2016, Shade sold to Pastel $500,000 worth of merchandise, of which 75% had been resold by Pastel in 2016. Pastel owes Shade $75,000 on December 31st, 2016 due to these purchases. We're going to cross out the next line because that relates to another transaction in the previous year. But we need to know that Shade Company's sales are priced to provide it with a 60% gross margin on its sales price. So based on the way the information is presented, we'll assume that that gross margin relates to both years. Okay. So step 1, has there been an intercompany sale during the current year? Yes, and the value of that sale was $500,000. So our first entry will be to eliminate that intercompany sale. Now I haven't provided individual headings on each of my entries within the transaction, but it certainly wouldn't hurt. Right? For example, we could call this 4C transaction 1. Second, we need to deal with the elimination of any intercompany profit. So we know that that Shade earned 60% gross margin on its sales. So the easiest way is to take that total value of the sales and figure out what is the total profit on the sales, and then we can figure out the unrealized portion. So we had $500,000 in sales, and we know that 60% of that is profit or margin, which tells me that $300,000 of that sale was profit, okay, not the original cost of the goods. Of that $300,000, we know 75% has been resold, which tells me that 25% is still sitting on parents' books and the profit is unrealized. So we have $75,000 in unrealized profit. It also tells me that the inventory value sitting on parents' books is overstated by that $75,000 because that extra $75,000 is profit, not the original cost of the goods. So our elimination entry needs to increase our COGS. That's our way of eliminating the additional profit, and bring down our inventory value by that $75,000. Next, we have to deal with our deferred income taxes. So we're going to use the seller's rate. We have $75,000 in unrealized profits that we're going to have to pay tax on this year, but don't want to recognize the profit or the related tax until a later year when the inventory is actually sold to a third party. We're going to use sub's tax rate of 30%, which tells us we're going to have a future income tax or a deferred income tax asset of $22,500. Essentially, we are prepaying the income tax now, and we will recognize it later when we recognize the profit. A good check here is that we expect that the effect of our taxes will have the opposite effect of our income statement impact of eliminating the profit. Right? So we can see our income statement account is COGS here, which is a debit of $75, offset by the DIT expense of $22,500. Right? We'd expect those to be going opposite directions and offsetting each other as they are. And then finally, NICSHI. This is an upstream transaction from Shade to parent, and we have adjusted profit net of tax. So let's take our $75,000 net of tax, and NICSHI owns 10%. So NICSHI has to share in this adjustment to subs net income as well as parent. and so we'll see that NICSHI ends up with a drop of 5,250. Now, if you remember when we allocated to NICSHI, that was in step 3, and that was based on the raw income and retained earning figures up to the end of 2016. It didn't include any of these adjustments, which is why we now need to come back and adjust NICSHI in a small amount for these additional changes, because the retained earnings figures we used in step 3 included this unrealized profit. So we're going to take $5,250 from the value we've allocated to NICSHI and put it back into retained earnings. Finally, we cannot forget that Pastel owes Shade $75,000 from these purchases. So we have a receivable and payable between parent and sub, and we need to eliminate those because it's a payable or receivable to ourselves. Not part of our original 4 steps for intercompany inventory, but the additional case information tells us that there is a payable receivable outstanding that we need to eliminate. On to 4D, our 2015 upstream sale of inventory. So still upstream, but this time we are beginning in the previous year. So if the intercompany sale between parent and sub originated in 2015, we're now in year 2 of this transaction. So what would have happened last year on our consolidated financial statements is we would have had to do elimination entries similar to what we just did in 4C to eliminate the intercompany profit, eliminate the intercompany sale, and record the related DIT and NICSHI. Now we're in year 2. So in year 2, this is when we actually would recognize the profit because we assume if the inventory was not sold to a third party in year 1, that now it's being sold to a third party in year 2. So the effect of our elimination entries, if it's an intercompany sale where there's profit involved, in year 1, the effect of our entries would be to bring down our net income. In year 2, it's going to go up because we're now going to be realizing the profit that we eliminated last year. The additional complication is that year 1 was never posted anywhere. So we have to record the effects of year 1 in year 2, as well as year 2 in year 2. So let's get started. Our first step was to eliminate the intercompany sale. Now we know the intercompany sale was eliminated last year, and our entry is to debit sales, credit COGS. If we record the same entry this year, it's just debit retained earnings, credit retained earnings. Okay, so no actual impact on the current year financial statements. So in this case, we won't write it down. It's not incorrect to include it. Okay. Now here's the information for this year, or for this transaction. December 31st, 2015, inventories of Pastel contained $300,000 of merchandise purchased from Shade in 2015. So we actually don't know the total amount of the sales. All we know is the portion that were unsold at the end of the year. Now of that $300,000, we know that 60% of it was profit, which would have been eliminated in the 2015 financial statements. So that tells us there's $180,000 in unrealized profit included in that amount. So first, let's eliminate it from last year. So we're going to deal with year 1 in year 2, or 2015 in 2016. So instead of debiting COGS, this time we have to debit retained earnings because it would have been COGS last year, which would have closed to retained earnings at the end of 2015, and would have affected opening retained earnings coming into 2016. So our elimination entry records the same impact that would have happened if we'd actually recorded the journal entries on our books and rolled everything forward into 2016. Now that's dealing with 2015 in 2016, but now we want to realize the profit. So our entry is going to be just the reverse. Our net effect on inventory is now 0, and we're going to realize the profit through a reduction in COGS, or a credit to COGS. Now, as you can see, the inventory amounts cross out, they offset each other, and so we could just record a debit to retained earnings and a credit to COGS to show that really all that's happening here is a movement of profit between one year and the other. It'd be perfectly correct to show just that one entry. Then we have to deal with our deferred taxes. So for our deferred taxes, we have $180,000 times, again, subs rate because it's upstream. So we'll have deferred income tax of $54,000. Now to set up year 1 in year 2, or 2015 and 2016, we'll record that DIT asset and record the credit through retained earnings because it would have been DIT expense, but of course it was last year, so now we put it through retained earnings. This year we're actually going to recognize the deferred income tax expense. At the same time we're recognizing the additional profit through the reduction in COGS. So we can see that these two amounts will offset as we're expecting, and we'll eliminate the did asset. Just like in our first two entries, this third and fourth entry, we could eliminate the did asset, debit and credit, and we could just debit did expense and credit retained earnings for the $54,000, and that would have the same impact in one entry as opposed to two. Now finally, NICSHI. By the end of the second year, so we know in year one we've decreased net income, year two we increased net income. By the end of the second year, the effect on retained earnings should be zero, on ending retained earnings. Okay? NICSHI is allocated a portion of retained earnings. So if there's no effect by the end of the year, we don't need to make any adjustments to NICSHI. Now you could choose to take away from NICSHI like we did in the previous one and then give back to NICSHI, but your entries are going to offset and have no effect. Right, so we don't need to record any entries here. A good double check would just be to make sure that our entries are not going to, they have no effect on ending retained earnings. So if I check all of my accounts that impact retained earnings, the 180 does, debit, so does the adjustment to COGS, right, affects ending retained earnings. This 54,000 credit to retained earnings offsets by the did expense of 54,000, so we can see that our effect on retained earnings, ending retained earnings 2016, is zero, and therefore is a zero effect on NICSHI. Okay, so on to 4E, our 2015 downstream sale of inventory. During 2015, Pastel sold $300,000 of merchandise to the Shade Company and earned a total gross profit of $120,000 on these sales. On December 31st, 2015, $150,000 of this merchandise is still on the inventory of Shade. So this is last year's transaction where the actual intercompany sale took place. A portion of the profit was unrealized at the end of the year and would have been eliminated in 2015, which we now need to realize in 2016. So let's calculate that by starting with the total profit on the transaction of $120,000. And to figure out the unrealized portion, we're told on December 31st, $150,000 of this merchandise is still in the inventories. Well, $150,000 out of the total $300,000 tells us that 50% was unsold to a third party, so unrealized, and therefore we have $60,000 in unrealized profit. So, for our entries, we cannot record to COGS. For last year's elimination of profit, it goes through retained earnings instead, but in the current year we're going to realize the profit through COGS. Just like we saw in the previous year two transactions, for inventories, we could have just debited retained earnings, credited COGS, and that would have been perfectly correct. For our DIT, we're going to now use Shade's tax rate because we're going upstream from sub to parent. So we're going to take our $60,000 and we're going to multiply it by the tax rate of Shade, 40%, which tells us that our DIT is going to be $24,000. So we'll record our DIT expense via retained earnings last year, setting up that DIT asset, and actually record the DIT expense as a debit this year, clearing out the asset. Again, we could just cross out our DIT assets because by the end of the second year, it's just an adjustment from retained earnings in the previous year, DIT expense in the current year. So we're moving that income from one year to the other. Finally, NICSHI. This is a downstream transaction, so we don't need to worry about NICSHI at all because it's parent's profit we're eliminating, not subs. So no NICSHI. I'd still like to mark it down. Not incorrect to leave it, but it reminds me that I've looked at that step. The second transaction that was identified in that paragraph, we've identified as 4F, our 2016 downstream sale of inventory. So during 2016, Pastel sold merchandise which had cost it $60,000 to Shade for $150,000. None of this merchandise was resold in 2016. So 100% of the profit related to this intercompany sale is unrealized at the end of 2016 because none of the inventory has been sold to a third party. And these purchases have not been paid for. So we're going to have a receivable payable to deal with. So step one, eliminate the intercompany sale. Well, our actual sale was for $150,000. So we'll eliminate that sale by debiting sales, crediting COGS. Then to figure out our unrealized profit, well, we're told the total sale was $150,000 and it cost us $60,000. That tells me the total profit, which is also the unrealized profit in this case, is $90,000. We'll eliminate that by increasing COGS and bringing our inventory back down to its original value of $60,000. Next up, our DIT, using parent's tax rate. So we'll take our $90,000 of unrealized profit, multiply it by the 40%, and we get a DIT of $36,000. So we'll set up the DIT asset and record the related DIT expense, remembering that the impact on net income should be opposite of the entry for COGS, and it is. And finally, NICSHI. We don't need to worry about NICSHI because this is a downstream transaction. Lastly, we cannot forget that Shade has not paid for these purchases, so the full amount of the purchases we need to eliminate from the receivables and payables. So we'll debit the current liability and credit the current receivable. We're on to an intercompany sale of a capital asset. Now, similar to the 4 steps we looked at for inventory, of how to deal with the elimination entries for a intercompany inventory transaction, we can take the same approach with capital assets. The difference will be that we will never have an intercompany sale to eliminate, in the sense that there will not be sales and COGS. The nature of the capital asset is that when a capital asset is sold from one company to the other as a capital asset and not inventory, we'll see a transfer of an asset from one to the other and potentially a gain or a loss on that transfer. We won't see COGS, we won't see sales. So let's look at the information given for our first intercompany capital asset transaction. This was number 9 in our other information. On January 1st, 2013, Shade sold a piece of equipment that had purchased on January 1st, 2010 for $180,000 to Pastel for $120,000. On January 1st, 2010, the equipment had an estimated useful life of 18 years with no net salvage value, and there is no change in these estimates at the time of the sale to Pastel. So we have an upstream sale of capital asset, in this case equipment. It was on January 1st, 2013. We're now at the end of 2016. So we are 4 years later. We have 3 prior years to deal with, 2013, 2014, 2015, and we have the current year, 2016, to deal with. The equipment was also sold at a loss. It was sold, it was originally purchased for $180, sold for $120. Okay. The loss we have to actually calculate because there's been some amortization during that time between when it was purchased and when it was sold. So a few tricky things going on. The best thing for us to do is to start by looking at what did the sale look like on the books of Shade and on the books of Parent. Now the books of Parent is the simplest scenario. In the books of Parent, they acquired some equipment and they paid out some cash. There's no indication this hasn't been paid, so we have to assume that it was. The equipment they would have acquired on their books at the purchase price of $120 and paid out $120. Parent would have also recorded amortization for each year. So we'll just look at 1 year of that amortization. We would have had an amortization expense, and we would be crediting accumulated amortization, but because we're looking only at reporting, we're going to actually credit the equipment. Remembering there is no accumulated amortization on our financial statements, we're reporting net, and so any adjustments to accumulated amortization must go through equipment. Our amortization is based on the $120,000 over the remaining 15 years, so it's going to be $8,000 per year. 4 years, so we've had $32,000 in total amortization that's been taken by Parent to date. Now let's look at Sub's books. We know that Sub originally purchased the equipment for $180,000. They received cash of $120. There'd be some accumulated amortization. Again, I will call it equipment, in this case recognizing that it is accumulated amortization. And that accumulated amortization was based on the $180,000 purchase price divided by 18 years, so $10,000 per year, and they had the equipment for all of 2010, 11, and 12, and sold at the beginning of 2013. So 3 years at $10,000. We have our equipment, which would be accumulated amortization, likely on our books here, for $30,000. That leaves us with a loss on the sale of $30,000. So what's wrong here? What do we need to deal with in our elimination entries? Well, we have a piece of equipment now sitting on Parent's books being depreciated at a value of $120,000. We know that value is incorrect for the consolidated entity because it should be based on subs values, and for sub it was still sitting there at 150. It should have been depreciated at $10,000 a year because it hasn't been sold to a third party. We're only depreciating it $8,000. So that's the additional piece we have with a depreciable capital asset. Not only do we have this loss on the sale resulting in an incorrect value, or in this case an understated value of the equipment, we also have amortization being recorded each year that's wrong. For the consolidated entity it should be $10,000, but we're only recording $8,000. So let's look at how to deal with this in our entries. So the first thing we're going to do is deal with this loss and the fact that the equipment is recorded $30,000 too low. Remember, it was still on the books at 150, which is a net between the 180 and 30, and it's now on the books at 120. So our first entry will be to bring the equipment back up to its appropriate value and adjust by eliminating the loss. Now remember, we are 4 years later, and so this would have been loss in 2013 when we did the consolidated financial statements. But because we're several years later, we have to adjust through retained earnings. Now let's deal with the previous year's amortization. So I want to deal with all of the previous years, and then we'll deal with the current year. I want to do that because the previous years all have to go through retained earnings. If there's an income statement impact, the current year does not. So it's easier to separate them out. So we're going to deal with 2013, 2014, and 2015 amortization expense. So we know that it should have been 10,000. What was actually recorded was 8. So we're off by 2,000 per year, and we have 3 years to deal with. So that tells me we have a $6,000 adjustment to make to amortization expense, but it should have actually been higher. Now, if that was recorded each year, it would have gone through retained earnings. So we're going to debit our retained earnings, which decreases our retained earnings, showing the increased amortization expense, and put that back into equipment, or bring our equipment down rather, to reflect the additional amortization. Right, typically this would go through accumulated amortization. We're using equipment because we report net on the financial statements. There is no accumulated amortization account for us to adjust to. So that's the previous 3 years. Now let's deal with 2016 amortization. Same idea, just $2,000, but this time we can actually adjust through amortization expense and adjust through equipment, where it typically would be accumulated amortization. Now we're going to deal with the deferred income tax implications. So for tax purposes, we have a net loss here, but we're eliminating that for accounting. So we're going to end up with a deferred income tax liability in this case. So let's deal with the previous years first, and then we'll deal with the current year. So all of the previous years together, if we look at the total effect, we had $30,000 offset by the $6,000 adjustment to amortization. So we have a $24,000 adjustment to income, and we're going to use subs tax rate because we're going upstream. So we're going to end up with a deferred income tax liability of $7,200. So let's set that up. Our adjustment goes through retained earnings. It would have previously been a deferred income tax expense when it was the current year for that related tax. And we have to look at our current year. $2,000. This time is a decrease to net income multiplied by the $30,000 subs tax rate gives us a $600 adjustment to our current year. Now, recognizing that this is going the opposite direction from the previous year entries, we can see that the previous year amounts, the $30,000 was a credit offset by the $6,000 debit, so we had a $24,000 increase to retained earnings, reflecting that we were eliminating that loss net of accumulated amortization adjustments, or net of amortization adjustments. And now we're slowly recognizing that loss by recognizing additional amortization expense each year, $2,000 per year. So when we set up our DIT liability related to the previous year based on the net amount, we're now using up a little bit of that DIT liability each year. In the first year it would have been set up at 30,000 times the 30%, 3 years later at 24,000, and now we're going another $2,000. So by the end of this year we only have a $22,000 loss and the related DIT. So that's $600. You can see it's going to be a current year DIT expense, and as we'd expect, it's going to offset our increase in amortization expense, and we're using up a little bit more of that DIT liability. Finally, we'll deal with NICSHI. So we have to figure out the total amount we've impacted profit net of tax. So we had our 30,000 offset by the 8,000, or the 6 plus 2. We have the 7,200 was our prior year DIT, and we have the 600 offsetting that. So we're looking at a $15,400 increase to retained earnings, of which NICSHI gets to share in 10% of that. So we're going to allocate an additional $1,540 to NICSHI and take that out of retained earnings. Essentially, we've increased the profitability of sub here by eliminating the loss, net of amortization, net of our DIT, and so NICSHI gets a piece of that additional increase in sub's income. Our final intercompany transaction we identified as 4H, a downstream sale of capital assets. The information given: on December 30th, 2016, Pastel sold to Shade for cash of $1.5 million a building with a net book value of $800,000 and the land it was situated on, which had original cost of $200,000. Shade allocated $1.1 million of the purchase price to the building and the remainder to the land, and the building has an estimated remaining useful life of 25 years on this date. The gain on the sale is disclosed separately for reporting purposes on Pastel's books. So if we look back to our income statement, we did see that gain separately disclosed, and it was a gain of $500,000. Now, a lot of information here could be quite tricky, having a depreciable capital asset sold with a non-depreciable capital asset, but the saving grace here is that we're actually only had 1 day since this transaction occurred for when we're reporting. So essentially it's at the time of reporting. It doesn't particularly matter that it's a depreciable asset because no depreciation would have occurred yet. So like we did for our previous intercompany sale, let's look at what happened on the books of Pastel and what happened on the books of Shade. So let's start with Pastel. On the books of Pastel, they would have received cash of $1.5 million. With that cash, we would have eliminated our building that was sitting on the books for $800,000 and our land sitting on the books for $200,000. So we would have had a gain on sale of $500,000, and that agrees with what we were expecting based on what's on the financial statements. All right, and then what's happening on sub's books? Well, sub paid out the cash of $1.5 million, and for that cash, they purchased a building for which $1.1 million has been allocated to that building of the purchase price, and therefore there's $400,000 left for the land. So what are the problems here? Well, we've got a gain of $500,000, which cannot exist. It's on an intercompany sale between parent and sub, has not been realized because sub has not sold that land and building to a third party. We also have a building and land values that are both overstated when they should still be at the 800 and 200 from parent's books. So first let's deal with that gain and the overstatement of the land and building. We're going to eliminate that gain that we saw in the financial statements. The debit will bring that gain down to 0. Remembering that when we look at the statements, the account was called gain on sale, so it's a correct naming of the account. Depending on the question, it could be sales and other revenue, it could be other revenue where the gain is sitting. We may be told, or we have to figure out the most logical place for it to be situated. In this case, we're specifically told where the gain was. That will bring the building and the land back down to the values that they were on parents' books, as if this intercompany transaction never occurred. Now this gain, for tax purposes, we will have to pay tax on the $500,000, but we're not going to want to recognize that gain and the related tax until the land or the building are sold to a third party, or in the case of the building, it's fully amortized. So we need to record a deferred income tax asset related to that, and the related deferred income tax expense, remembering that these offset each other. And for our calculation, it was the $500,000 times parent's tax rate of 40% to give us the $200,000 deferred tax. We don't need to worry about NICSHI in this case because this is a downstream transaction. Now that we've completed all of our elimination entries, we're on to our next required, which is a variety of direct balance calculations. Now, direct balances can be calculated one of several ways. One way is to use logic to consider what would be included in that balance at the particular reporting date, and in your workbook there are some guides for you of how to get to the particular balances. A second way would be to complete the entire set of financial statements. So if you complete the statements and calculate the balances for each particular account, that will help you calculate things like consolidated net income, consolidated retained earnings, because they come from the consolidated balances of other accounts. The third way is to use your elimination entries to calculate your consolidated balances. Since we have done all of the elimination entries, the only way something can end up in our ending consolidated balance of an account is if it's in the balance of parent at the reporting date, the balance of sub at the reporting date, or comes from one of our elimination entries. There's no other way for an adjustment to end up in a consolidated balance. It must be from the books of parent, from the books of sub, or from one of our elimination entries. One of the common errors that I see in direct balances is seeing numbers sort of appear in the direct balances that have not been part of our elimination entries. Because we have done all of the elimination entries necessary and we have our balances at December 31st, 2016 for parent and sub non-consolidated, we're going to use this third approach to calculate our consolidated balances for specific accounts. So the first one that we've been asked to calculate is sales. So we'll start with our balance of sales for parent on December 31st, 2016, which was $8 million, and sub on December 31st, 2016, which was $2 million. But then we need to go back to our elimination entries and see which ones impact sales. Now this is as simple as starting at our first elimination entry, which was our investment elimination entry, and looking for sales. As we go through our entries, the first time that we see sales is in 4C, our 2016 upstream sale of inventory. So we can see we had a debit to sales, a decrease to sales of $500,000 here. This logically makes sense because we're eliminating the sales. So from what we had on the books of parent and sub, we're now bringing sales down by $500,000 to get rid of the intercompany sale. We keep going. Next time we saw sales was in 4F, our 2016 downstream sale of inventory. So same idea, it's a current year intercompany transaction, and we need to eliminate those sales that would have been recorded on the books. Continuing through our entries, there are no other balances that affect sales, so here's our final calculation. When you're calculating your direct balances in your response, it is very, very important to include descriptions of where each of your numbers are coming from, and especially important to include references. So you can see in my right-hand column, I've said I pulled the parent and the subs consolidated or non-consolidated sales balances from the income statement, and the $500,000 intercompany sale came from transaction 4C, the $150,000 from 4F. That way, if you pull the wrong numbers, or more likely you have an incorrect number in your entry, but you carry it through correctly, you'll still receive credit here. Next, COGS. So we'll take the same logic. We'll take parent plus sub plus the various elimination entries we've prepared that impact COGS. So starting with our investment elimination entry, first time that we see COGS show up is in 4C, our intercompany inventory transaction. COGS appears here twice, so the $500,000 from the elimination of the sale and the $75,000 offsetting that, eliminating the intercompany profit. So both of those amounts will need to be pulled into our calculation. Now you could choose to net the amounts to include in your direct balance, but if you choose to do so, make sure you show a calculation either in the right-hand column of the elimination entries, so it shows the reference going to go to consolidated COGS, or show a calculation in your direct balance. In 4D, we can see $180,000 credit to COGS. In 4E, we have a $60,000 credit to COGS, representing that realization of the profit. In 4F, we have the $150 from the intercompany sale elimination and the $90 offsetting that from the elimination of the profit. And that's it. So a bit more to this one. So first we have parent and sub coming right from the income statement. We have these two from our first intercompany inventory transaction, just the 180 from our second, 2 from our third intercompany inventory, 1 from our third intercompany inventory, and 2 from our fourth, to get a consolidated COGS at the end of the year of $3,875,000. You can see with so many calculations and figures included here, it is critical to reference them to where they're coming from. If you just include a bunch of numbers, or even just say intercompany inventory, there are so many transactions here. If your numbers are wrong, it won't be able to receive the credit for them because the person reviewing your work will not be able to follow them through. Next, consolidated inventory. So again, we'll start with parent's balance on the books, sub's balance on the books at December 31st, 2016. And we'll go back to our entries. And the first time that we see inventory is in 4C. Right, we're decreasing inventory by $75,000 to eliminate that unrealized profit that's included in inventory. And the next time we see it, same thing. This time a downstream transaction, but nonetheless it's decreasing inventory by $90,000. You can see in the year 2 transactions, intercompany inventory transactions, like for example 4E, inventory is both debited and credited, so I've not included it because it has no impact on the ending consolidated balance. It is not incorrect to include both of these amounts because they would offset and have no impact. So our final consolidated inventory comes from parent and sub's books. And then we've got two amounts decreasing the inventory values for the unrealized profit from those two intercompany inventory transactions. Next we have equipment. So equipment, we have to go all the way back to our first intercompany, our first elimination entry, our investment elimination entry, because equipment was one of the accounts where there was a fair value decrement in this case. So we'll start with parent and sub's balances at December 31st. Like we did in the other ones, and the first thing we're going to adjust is bring equipment down by $1 million to bring sub's value at the date of acquisition down to fair value. Then we'll go to our fair value increment amortization, and we can see that 500,000 of that million has been amortized, so we will add back 500,000. And then equipment doesn't show up again until we get to our intercompany sales of equipment. So for G, we see equipment show up in 3 places, so we could choose to combine those together or keep them separate. I chose to keep them separate. And then when we get to our consolidated balance, we'll pull each of those items in. So the $1 million decrement offset by the amount that's been amortized of 500,000, and then the 3 values that came from our intercompany equipment sale, leaving us with the consolidated equipment balance at the end of 2016 of $27,522,000. Now I've skipped over net income. I'm going to come back to net income because net income and retained earnings are our 2 trickiest balances, so we'll calculate those last. Next we'll calculate NICSHI. So NICSHI does not exist on the books of parent or sub, so we would not expect to have a balance for parent or a balance for sub on their non-consolidated statements at December 31st, 2016. NICSHI is only a product of our consolidation, so we should be able to find all of our entries for NICSHI in order to figure out the sum of them for our total NICSHI balance. NICSHI is often one where, for some reason, we don't go back to our entries. We start just trying to calculate it off the top of our head, so we've already got the information and the calculations completed for us. So let's jump back, all the way back to our first elimination entry. And in our first elimination entry, there was our initial value for NICSHI of $567,000. So that will be our starting point for our direct balance calculation for NICSHI. NICSHI shows up again in our third elimination entry, where we allocate a bit more to NICSHI, representing the current, the years since acquisition, additional portion of retained earnings for them. And then NICSHI appears in some of our upstream transactions. So we take a little bit away from NICSHI for the elimination of the profit in this intercompany inventory sale, 4C. And we give a little bit back to NICSHI for this intercompany capital asset sale at a loss. Pull all of those amounts together, and we end up with a consolidated NICSHI of $787,790. So net income and retained earnings are our two trickiest balances. The reason for that is because so many things impact net income and retained earnings, and it's not as simple as going through and looking for the particular account, net income or retained earnings, because there is no account we're debiting or crediting called net income, and there are accounts that affect retained earnings that are not called retained earnings. So our most logical approach for this is to go through the elimination entries that we have done and calculate the sum effect, or the net effect on net income and in this case retained earnings, because we have both balances to calculate for each of the sets of entries. Once we've done that, we'll be able to pull that summarized information into our net income and retained earnings calculation. So let's go back to our very first elimination entry. This also provides us with a little bit of a logic check to make sure that our entries make sense. In fact, they're having the impact on net income and retained earnings that we're expecting. So in our investment elimination entry, we have no accounts that impact net income. So I'm looking for income statement accounts, revenue, and expense accounts. There are none here. So in the right margin next to my entry here, I'm going to say my impact on net income is 0. But what about my impact on retained earnings? And here I'm implying ending retained earnings at December 31st, 2016, and I will be for the rest of the question. Well, I go through here, and the only one that impacts retained earnings is the $4 million. I'm going to switch over to green here so we know what we're doing compared to our previous notations. Alright, so we know that the total impact of the investment elimination entry is no impact on net income and $4 million decrease on retained earnings. That logically makes sense, as one of the purposes of this entry is to eliminate subs-retained earnings upon acquisition. When we go to our fair market value increment amortization, we've actually already calculated this. Right? We did so in order to compare to our calculations in our goodwill schedule. And so when we go to calculate net income or retained earnings direct balances, we could reference these particular entries. We could also reference our goodwill schedule, remembering that it's very important if we reference our goodwill schedule that it actually matches our entries. We can't have an adjustment in our goodwill schedule that ends up in a direct balance if it didn't go through an entry first. Next, looking at our allocation of retained earnings to NICSHI, while we can see very clearly that this has an impact on retained earnings of a decrease of $224,500, however, no impact on 2016 net income. This makes sense, as this is not a net income calculation or net income adjustment, it's just an adjustment between one equity account and another. Intercompany dividends. So our first entry has the impact on net income of decreasing net income by $90,000. That's expected as we're eliminating the $90,000 other revenue. However, we often get the impact on ending retained earnings incorrect. Remember that anything that impacts current year net income also impacts ending retained earnings. So the $90,000 debit will impact ending retained earnings as well as the credit to retained earnings. So ultimately the impact on ending retained earnings is 0. This is one of the reasons that we only have to deal with dividends in the current year. We don't need to deal with prior year dividends, because in the following year, to reflect this 2016 dividends, we would have an entry of debit retained earnings, credit retained earnings in 2017. So that tells us that we only need to deal with dividends, intercompany dividends, in the current year. Our payable and receivable will have no impact on net income or retained earnings. On to 4B. We have a revenue and expense entry that offset each other, so we'll have no impact on net income and ultimately no impact on retained earnings either. And neither will our current liability or current receivable adjustments. On to our intercompany sale of inventory, 4C. So these get a bit trickier with more accounts, more adjustments. Let's start by dealing with net income. So like we did in the our first look at the fair market value increment amortizations, looking at impact on net income and retained earnings, let's go through and circle all of the amounts that impact net income. So we take those 4 amounts, we'll see a total impact on net income of a net debit or decrease of $52,500. So if we take a moment and think, does that make sense? Well, we're in the first year of an intercompany inventory transaction. It was a profitable intercompany inventory transaction. So yes, we're eliminating a profit from the current year. So we'd expect to have a decrease in net income. Looking at the impact on ending 2016 retained earnings, all of the accounts we've already circled will impact ending retained earnings, as well as any adjustments to actual retained earnings. So we can see that retained earnings has been impacted by a decrease of $47,250, a little less than net income because of that small adjustment for NICSHI. On to 4D. This is our prior year intercompany inventory upstream transaction. So again, impacts on net income. We'll look for the accounts and circle them. Only 2 in this case. So for 4D, we have a net income impact of an increase of $126,000. In this case, we're in year 2. It's the year that we're recognizing the profit on this intercompany sale, so it makes sense that net income is going up. At this point, if, for example, we got a decrease in net income and we logically went, it should be going up, not down, that's a chance to revisit our entries and see if or where we've made an error. What about our impact on ending retained earnings? Well, if we take the accounts we've already circled and we add in retained earnings, we see that the net impact on retained earnings is 0. Again, this makes sense. We're at the end of year 2 of an intercompany inventory transaction. We've realized the profit in the current year. We've eliminated the profit from the prior year in the current year with via retained earnings. So by the end of the second year, this inventory transaction is complete, it's done, it should have no impact going into year 3. This is why when we're in year 3 of an inventory transaction, for example, in this question, it's an inventory transaction that originated in 2014, we wouldn't have any entries to do. They would all be debit retained earnings, credit retained earnings. For E, let's start by circling our income statement impacts. So we can see for 4E our impact on net income is an increase of $36,000, and our impact on ending retained earnings is 0. Since we're in year 2 of a profitable intercompany inventory transaction, it makes sense that we're recognizing the profit in the current year, so our net income is increased, and by the end of the second year, or the current year, retained earnings impact is 0, because we've decreased retained earnings coming into the year, or last year's net income, and we've increased net income for the current year. For F, we'll start by circling all of our accounts that impact net income. We can see that the impact on net income is a decrease of $54,000. As expected, it's a current year inventory transaction. We're eliminating the profit from the current year. And our impact on ending retained earnings will include all of those, and in this case, nothing else, because there is no NICSHI involved because it's downstream. So the same impact on ending retained earnings. For capital assets, let's start by circling all of the amounts in that are going to impact our income statement. There's only a couple. So you can see that the impact on net income for the current year is only going to be $1,400, the decrease. And the impact on ending retained earnings will have to include all of our other adjustments here. So we'll see an impact on ending retained earnings, an increase of $13,860. The current year amount is showing a decrease because we're slowly recognizing a portion of that loss net of tax by increasing our amortization expense, but still over the last 4 years, we are still eliminating a net loss. So it makes sense that our retained earnings impact by the end of 2016 is still a positive impact. Our final transaction, looking at the downstream sale of the capital asset, look at our net income impact. We can see the gain offset by the DIT expense. So eliminating the gain net of tax decreases our net income by $300,000. And at the end of the current year, there are no other adjustments to impact retained earnings, so the same impact on retained earnings, a decrease of $300,000. Now that we've done all these calculations, all that's left to do is to create a table or a list and input all of these amounts with references to the various transactions for both net income and retained earnings. So we can see for net income, we start with the amounts from the income statement, parent and sub. We bring in the $27,000 increase to net income, right? It was less expense from our fair market value increment amortization or from Exhibit A. The amounts should match from both. We eliminate the intercompany dividends. We have our all 4 of our intercompany inventory transactions, all which impacted net income, and our 2 intercompany sales of capital assets, to bring us to consolidated net income of $2,391,100. As I mentioned, there are 2 other ways we could get here. We could look at specifically at logic, what sort of things to include in our net income calculation, and there are examples in your workbook of how to do that. Or we could have done the entire set of financial statements, an entire income statement, and calculated consolidated sales, COGS, etc., in order to come out to a consolidated net income figure. But because we have all of our direct balances already done, this is the most logical way for us to calculate it. For retained earnings, again, we'll begin with parent and sub. We have that elimination, $2 million right off the bat in our investment elimination entry. We have our adjustment that came from our fair market value increment amortization, as well as from Exhibit A. Again, the amounts must match. And then we have our allocation to NICSHI, which decreases our retained earnings, our consolidated retained earnings. We had 2 intercompany sales of inventory that impacted our ending retained earnings, and both of our capital asset sales impacted ending retained earnings, to bring us to consolidated retained earnings at December 31st, 2016 of $21,618,110. That's all of our required, and this concludes this video on consolidation.